In a notable realignment of global energy flows, China's imports of U.S. crude oil have experienced a sharp decline, nearly halving in volume. This shift reflects not only changes in China's energy priorities, but also a broader restructuring of global oil dynamics. According to recent data from Capilare, China's crude oil imports from the U.S. dropped from 115.6 million barrels in 2023 to just 81.9 million barrels in 2024, a staggering 46% decrease. As a result, China has fallen from the second largest buyer of U.S. crude to the sixth largest, a significant shift with far-reaching implications. Below, we delve into the primary drivers of this decline and its impact on the global oil landscape. China's changing energy strategy. China, the world's largest oil importer and the second largest consumer, has historically relied on a diverse range of sources to meet its vast energy needs. However, recent data reveals a 7.2% year-on-year drops in China's total crude imports attributed to intermittent COVID-19 shutdowns, high local reserves, and expected refinery upgrades. Despite this overall downturn, China's procurement strategy has shifted significantly, focusing on securing more favorable and flexible terms. Customs data highlights a deliberate reduction in imports from certain Western exporters, signaling China's effort to optimize costs and enhance energy security. For instance, the share of China's seaborne crude imports originating from Russia, Iran, and Venezuela has risen slightly, from 24% to around 26%, according to Kapler. While this 2 percentage point increase may seem minor, it represents a significant volume given China's massive daily crude import levels, often exceeding 10 million barrels. Russia, Iran, and Venezuela. Key suppliers. Russia has emerged as a prominent supplier, offering substantial discounts on its Urals-grade crude due to Western sanctions. These discounted prices are particularly attractive to Chinese refiners, who seek to minimize feedstock costs. Similarly, Iran continues to supply crude to China despite U.S. embargoes, employing stealth tactics such as disabling vessel transponders and conducting ship-to-ship transfers off Malaysia or the Gulf. Venezuela, constrained by severe U.S. sanctions, also exports to China via complex payment mechanisms and intermediaries. Although these channels can be convoluted, the low prices offered by Venezuela remain appealing, particularly for smaller Chinese refineries. Collectively, these discounted supply chains have partially offset the decline in volumes from Western exporters, reinforcing China's ties with diplomatically isolated suppliers. Financial and geopolitical motivations. China's pivot towards sanctioned or lower-cost exporters is driven by a mix of financial and geopolitical considerations. On the financial side, Chinese refiners benefit from substantial profit margins by purchasing crude at prices well below global benchmarks. This allows them to either lower domestic fuel prices or increase shipments of refined products, particularly within Asia. On the geopolitical front, diversifying its suppliers enhances China's energy security by reducing dependence on any single source. This strategy minimizes exposure to potential political disruptions. Additionally, by fostering closer relations with countries like Russia, Iran, and Venezuela, China strengthens diplomatic and trade ties with nations eager to circumvent Western sanctions. This approach further solidifies China's role as a global energy player willing to operate outside the influence of the US-led system. The complexities of sanctioned oil trade tracking the flow of crude from sanctioned nations to China is a challenging task. Analysts from firms like Capilare and Vortexa rely on tools such as satellite imagery, automatic identification system, AIS signals, and port logs to monitor vessel movements. These records reveal methods employed to obscure the origins of crude oil shipments, including disabling AIS signals and conducting mid-ocean transfers, often off the coast of Malaysia. China's customs statistics may not fully capture imports from Iran or Venezuela, as some volumes are misclassified as originating from other nations, such as Malaysia or Oman. Nevertheless, the increase in deliveries from these countries underscores China's calculated efforts to capitalize on pricing gaps. Even a modest 2 percentage point increase in import share represents billions of dollars and has significant implications for global shipping routes and supply chains. This shift pressures traditional suppliers like Saudi Arabia, Angola, and Brazil to adjust their pricing strategies to maintain market share, further reshaping global oil dynamics. Implications for global oil markets. China's evolving oil procurement strategy has far-reaching consequences for global energy markets. Its increased reliance on heavily discounted crude from embargoed nations undermines the effectiveness of Western sanctions, highlighting the loopholes that keep oil flowing despite restrictions. By prioritizing cheaper crude, China influences global price benchmarks and market sentiment. This trend could prompt existing suppliers to lower their prices, triggering adjustments in supply routes and contract terms. The situation is particularly precarious for Russia, a key member of the OPEC Plus alliance. Russia's discounted oil exports to China risk undercutting the group's collective efforts to maintain higher prices. Over time, tighter energy ties between China and sanctioned states may also reshape global alliances, positioning Beijing as a pivotal energy buyer willing to operate outside the Western framework. These developments not only ensure affordable energy supplies for China, but also enhance its global bargaining power, paving the way for significant shifts in energy and diplomatic relations. The rise of renewable energy and electric vehicles. China's growing adoption of electric vehicles, EVs, is another factor influencing its oil consumption patterns. As more Chinese consumers opt for EVs and the government accelerates electrification in transportation and industry, the country's reliance on oil is expected to decline. Additionally, China's increasing use of cleaner energy sources, such as liquefied natural gas, LNG, further reduces its dependence on petroleum-based fuels. This transition aligns with global efforts to promote sustainability and reduce carbon emissions. Strengthening ties with Saudi Arabia. China's energy relationship with Saudi Arabia has deepened in recent years, expanding beyond traditional crude oil trade to include renewable energy and technology ventures. In 2023, bilateral trade between the two nations reached $87.23 billion, driven largely by oil exports. Both countries are also collaborating on clean energy initiatives. Saudi Arabia's Vision 2030 plan, which aims to generate 50% of the kingdom's energy from renewable sources by the end of the decade, has drawn significant involvement from Chinese firms. For example, in August 2024, China Energy Engineering signed a $972 million contract to construct a 2-gigawatt solar farm in Saudi Arabia. Similarly, Chinese company Sunro Power Supply partnered with Saudi-based Alphanar on an energy storage facility with a potential capacity of 7.8 gigawatt hours. China's financial engagement with Saudi Arabia has also grown. In November 2024, China selected Riyadh for its first dollar-denominated sovereign bond issuance in 3 years, signaling its support for Saudi Arabia's Vision 2030 and strengthening economic ties between the two nations. Russia's turn to the East. Russia's pivot towards Asia, particularly China, gained momentum after its 2014 annexation of Crimea and subsequent Western sanctions. This shift accelerated following the Russia-Ukraine conflict, which prompted even stricter measures aimed at isolating Russia. In response, Russia began offering discounted oil to China. By 2023, bilateral trade between the two nations exceeded $240 billion, with energy exports playing a central role. In 2024, China completed the Power of Siberia pipeline, increasing its access to Russian natural gas. Discussions are also underway to expand gas supplies through the proposed Power of Siberia 2 pipeline, which would redirect flows previously intended for Europe. These developments align with China's broader goal of diversifying its energy sources and securing long-term supply agreements. China's relations with Iran. China's energy ties with Iran have also been shaped by global sanctions. Despite U.S. efforts to restrict Iranian oil exports, China continues to purchase crude from Iran at discounted prices. This arrangement benefits both nations. China secures affordable energy supplies, while Iran gains much-needed revenue. Indite. October 2024, the U.S. imposed additional sanctions on Iran's oil and petrochemical sectors, aiming to cut funding for missile programs and other activities. However, these measures have done little to deter China's imports, underscoring Beijing's commitment to maintaining its energy partnership with Tehran. Growing trade with the UAE. Energy trade between China and the United Arab Emirates, UAE, has surged in recent years, reflecting a strengthening partnership. In 2022, the UAE exported approximately $17.4 billion worth of crude oil to China, making energy a cornerstone of their bilateral trade. By 2023, total trade between the two nations reached $95 billion, with non-oil trade accounting for $83 billion, 7.5% increase from the previous year. Both countries aim to double their trade volume to $200 billion by 2030, highlighting their shared commitment to deepening economic ties.